If you're under 35, one decision you make right now will matter more than your salary, your job title, or even where you live. It's a decision that once made will work for you silently every single day for the rest of your life. Get it right, and your future self will thank you profoundly. Get it wrong, or worse, don't make it at all, and you'll spend decades wondering what could have been. So what is this decision? It's not about finding the perfect job or the perfect city. It's about understanding the one asset you have in abundance right now that you will never have again. Time is the most powerful financial advantage you will ever have, and it's something you can't buy later, not for any price. Think about it. You can always find ways to earn more money. You can change careers, get a promotion, start a side hustle, but you cannot go back and reclaim your 20s. You can't purchase an extra decade of growth. This period of your life, from your early 20s to your mid-30s, is a unique window. It's a financial superpower. Every year that passes, that power diminishes slightly. Right now, your time advantage is at its absolute peak. It's a resource that's quietly slipping away, and most people don't even realize what they're losing until it's too late. The problem is, most people under 35 focus on the wrong things. We're conditioned to. We chase the higher salary, the better job title. We fixate on lifestyle and appearances, the nicer apartment, the new car, the latest phone. We're swimming in a culture of social approval, where the value of something is measured in likes and comments. The pressure is to look successful now, not to build sustainable wealth for the future. We think, I need to earn more money before I can think about my future, or I'll focus on that once I've got my career sorted. But this is a fundamental and costly misunderstanding of how wealth is actually built. It's a trap that keeps people on a hamster wheel, constantly working for money instead of having their money work for them. And that brings us to the big reveal, the single most important financial decision you can make before you turn 35. The decision that matters most isn't how much you make. It's not about landing a six-figure salary or climbing the corporate ladder. It is simply whether you start investing early. That's it. Not being an expert, not picking the perfect stock, just starting, opening the door and taking the first step as early as possible. That single action changes everything. It flips the script from you working for every dollar to your dollars starting to work for you. So why does starting early win? Why is it so much more powerful than waiting until you're making more money? It comes down to one powerful, unstoppable force: compounding. Albert Einstein supposedly called it the eighth wonder of the world. Here's how it works. When you invest, your money earns a return.
The next year, you don't just earn a return on your original money. You earn a return on your money plus the return it already generated. Your earnings start earning their own earnings. Imagine a small snowball at the top of a very, very long hill. When you first push it, it's tiny. It barely picks up any new snow. This is like your first few years of investing. It doesn't look like much is happening, but as it rolls, it gets bigger. And the bigger it gets, the more snow it collects with each rotation. After a few decades, that tiny snowball has become an unstoppable avalanche of wealth. That's compounding. It's a process that needs one crucial ingredient: a long, long hill. And for those under 35, you are standing at the top of the longest hill you will ever have. Let's make this real. Imagine two people, both smart and good at their jobs. We'll call them Alex and Ben. Alex starts investing at age 25. He puts in just $5,000 every year for 10 years, and then at age 35, he stops completely. He doesn't add another penny. His total investment out of his own pocket is $50,000. Now here's Ben. Ben decides to wait. He focuses on his career and starts investing at age 35, the same year Alex stops. Ben is more established, so he invests that same $5,000 every single year, all the way until he's 65. He invests for 30 years straight, putting in a total of $150,000 of his own money, 3 times what Alex invested. Who do you think has more money at age 65? It's not even close. Alex, the early starter who invested less, ends up with more. Assuming a modest 7% annual return, Alex could have over $600,000. Ben, who invested 3 times more money but started 10 years later, would have around $540,000. Alex's money simply had more time to work. That 10-year head start was more valuable than an extra $100,000 in cash. That is the mathematical power of starting early.
If it's so powerful, why do so many people delay? The reasons are almost always psychological. People delay because investing feels complicated, risky, or intimidating. We're hit with a barrage of jargon, ETFs, 401ks, Roth IRAs, diversification. It feels like a club we don't have the secret password to. Then there's the fear of losing money, of a market crash, of making the wrong choice. And finally, there's the most common excuse of all. I'll start when I earn more. It's a thought bubble that says, what I have right now isn't enough to make a difference, so I'll just wait. This combination of fear, complexity, and procrastination forms a powerful barrier that keeps millions of young people on the sidelines, missing out on their most valuable years of growth. But waiting doesn't just cost money, it costs time, and time never comes back. Every month you wait is a month of potential compounding growth that is lost forever. You can't get it back. It's like missing a flight. You can always buy a ticket for the next one, but you've lost the time, and the new ticket will cost you more to get to the same destination. When you delay investing, the price you pay is needing to contribute far more of your own money later in life to try and catch up. But you can never fully replicate the work that an extra decade could have done for you. That period of missed growth is a lost opportunity that can never be recovered. Now, it is critical to understand what this decision is not about. This is not about day trading, frantically buying and selling stocks based on a news headline. It is not about gambling on some high-risk crypto coin, hoping it will go to the moon. And it is certainly not about getting rich quick. Those activities are closer to a casino than they are to sound investing. They generate stress, anxiety, and for most people, significant losses. True investing is the opposite of that chaos. It's about getting rich slow. It's calm, it's boring, and it's incredibly effective. So what is it about? It's about three simple things: consistency, patience, and letting time do the heavy lifting for you. It's about setting up a small, automatic contribution every single month, whether the market is up or down, and just letting it be. It's about choosing simple, diversified, low-cost investments like index funds, and then having the patience to not touch them for decades. It's about understanding that the path to wealth isn't a jagged line of frantic activity, but a smooth, steady, upward curve built over a lifetime. You're not trying to beat the market. You're just trying to be in the market for as long as possible. This is precisely why the period under 35 is so critical. In this stage of life, you have the ultimate trifecta of advantages. First, you have flexibility. Your financial life is often less complicated. You might have fewer responsibilities like a mortgage or children, which allows you to dedicate a portion of your income to your future self. Second, you have decades of growth ahead of you, a long timeline that allows compounding to work its magic. And third, and this is huge, you have time to recover from mistakes. If the market takes a downturn, you have decades for it to recover and continue growing. A market dip in your 20s is a buying opportunity. A market dip at 64 is a crisis. Your youth provides a built-in safety net that older investors simply don't have. So let's bring this all together. The single most impactful financial decision you can make in your youth isn't about becoming a financial genius overnight. It's not about having a huge income or a perfect plan. You don't need to be perfect. You just need to start. Open an account, automate a small contribution. The amount is less important than the act of beginning. The first step is the hardest, but it's also the one that sets everything else in motion. Start early, stay consistent, and let time do the work.